Welcome to the deep dive. If you're looking at the investment funds in Canada exam, maybe just starting with Chapter 1, you're definitely in the right spot.
Yeah.
We're going to treat this as kind of an insider's guide, focusing on the really crucial stuff about what a mutual fund sales rep actually does in Canada. We want to make this chapter feel less, I guess, overwhelming and more like a solid foundation you could build on.
Exactly. Look, the aim isn't just rote memorization for the test, right?
Right.
We want to unpack these core ideas, the responsibilities, the principles, so they genuinely make sense. We'll hit the key things from Chapter 1 that you'll likely see on the exam, explained to me with examples.
Perfect. So if Chapter 1 of the IFC is on your radar, let's jump right in. What's the absolute fundamental role of a mutual fund sales representative?
Okay, so at its core, it's really about helping clients pick mutual funds that are, well, suitable for them.
Suitable.
Yeah, it's not about pushing a product. It's about understanding their unique situation. What are their financial goals? What's their current situation like? And importantly, how much risk are they comfortable taking? And then you recommend funds that actually fit all that. It's very, very client-focused.
Okay, so definitely not a cookie-cutter approach then. That seems like a big takeaway right away. And Chapter 1 talks about these 3 pillars of responsibility.
Yeah.
What should we really focus on there for the exam?
Right, the 3 pillars. For the exam, you absolutely need to know what each one means in practice. They are legal responsibility, ethical responsibility, and professional responsibility.
Got it.
Think of them as the essential duties you have to stick to.
Okay, let's tackle legal first. What's the main thing we need to know there for the exam?
Legally, the big concept, and you'll see this a lot, is suitability.
There's that word again?
Yeah. You have to understand that a rep has a legal duty stemming from provincial securities laws to make sure any advice given, any fund recommended, is actually suitable for that specific client. Suitable. Okay. It sounds simple, but Chapter 1 breaks it down. What actually makes an investment suitable according to the rules?
Good question, and definitely exam territory. Chapter 1 lays out key elements. First, does the investment actually line up with the client's goals?
Okay, like
if someone's saving for a house down payment needed in, say, a year or two, recommending a super volatile high-growth fund, probably not suitable.
right, too risky for the short term.
Exactly. But for someone saving for retirement, maybe 30 years away, a more growth-focused fund might be suitable. Depends on other factors too, of course.
Makes sense. The time horizon is huge. What else goes into suitability, legally speaking?
The client's financial condition is critical. We're talking income, debts, assets, net worth. Someone with a lot of debt might not handle potential losses, as well as someone financially secure.
So their ability to actually absorb a loss.
Precisely. That capacity is a key part of the suitability assessment.
Okay. Understanding their overall financial health, and I guess their personal life situation matters too. Oh, definitely. Think about it. Someone just starting out, single, versus someone nearing retirement with dependents.
Totally different needs.
Exactly. Their life stage, family, job stability, all these personal things influence what's suitable.
And what about their investment knowledge? Does that play into the legal side of suitability?
Yes, it does. A client who's a complete beginner needs simpler, probably less risky options and way more explanation than, say, a seasoned investor who understands market swings.
So the complexity has to match their understanding.
Right. And finally, there's risk tolerance.
How comfortable they are with the ups and downs.
Exactly. That's the legal definition in this context. Some people are fine with market volatility for potentially higher returns. Others just want to protect their principal. Understanding that emotional aspect, their comfort level, is legally required for suitability.
Wow. So legal responsibility, especially suitability, it's really this holistic view aligning the advice and the product with the client's goals, finances, personal life, knowledge, and comfort level.
You got it. That's the legal pillar in a nutshell. Now moving on. Ethical responsibility. What's the core ethical principle here for the exam?
Okay, ethically, I think the big one is putting the client's interests absolutely first.
Right.
Acting in their best interest above your own or the firm's.
That is dead center. Ethically, the rep must prioritize the client, even if it means, say, missing a sales target or getting a smaller commission on a more suitable but maybe less lucrative product. Conflicts of interest, they have to be managed, disclosed. Client first, always.
Why is that ethical piece hammered home so much in finance?
Well, think about it. Clients rely heavily on the rep's expertise. There's an information gap, a power dynamic.
Yeah.
Trust is everything. If clients suspect their advisor isn't acting ethically, the whole system gets shaky. So for the exam, just remember, ethics equals integrity, client first.
Like the moral compass guiding their actions.
Yep.
Okay, third pillar, professional responsibility. What are the key takeaways there for the exam?
Professional responsibility is about competence and diligence. Doing a good job, basically. The two big components you need to know are know your client, or KYC,
KYC, right.
and know your products, KYP.
We touched on gathering client info for suitability.
Yeah.
Is KYC basically that whole process?
Essentially, yes.
Yeah.
KYC is the ongoing process of gathering, verifying, and updating all that crucial client information we talked about. Goals, finances, risk tolerance, knowledge, time horizon.
All those pieces.
All those pieces. You'll definitely need to know those KYC categories for the exam. It's the foundation for everything else.
And know your products seems straightforward. Understanding the funds you recommend.
Pretty much, but it means knowing the details. The fund's objectives, its strategy, what it holds, the risks involved, the fees like MERS and sales charges, performance history.
Okay.
The Fund Facts document is your go-to resource here, and you need to know what's in that document.
So professional responsibility is competence plus integrity. Know your client, know your product.
Exactly. And one more crucial part of professional responsibility, tying back to suitability. It's the duty to actually decline a sale if the product is clearly unsuitable, even if the client insists.
Oh, interesting. So you might have to say no.
You might have to advise against it strongly or even refuse the transaction if it's just completely wrong for them based on their KYC. It shows professional integrity.
That really underlines they aren't just order takers. There's a real professional judgment involved. Okay. All these responsibilities, legal, ethical, professional, they exist within rules. Compliance. What's the key thing about compliance for the exam?
For the exam, understand compliance simply means following the rules. All the laws, regulations, internal company policies governing mutual fund sales.
Gotcha. Rule following.
It's all designed to protect investors and keep the market fair. Know that regulatory bodies, SROs, and the dealer firms themselves enforce these rules.
And if you don't comply, what are the stakes? Relevant for the exam, I mean.
Oh, the consequences are serious. Fines, suspensions, losing your license. Yeah, even getting banned from the industry for life. So understanding that non-compliance isn't taken lightly is important. It protects clients and the rep, ultimately.
Okay, let's circle back and really nail down KYC. It seems absolutely essential. Remind us of those essential facts when you just gather the ones likely to show up on the exam.
Definitely. For KYC, remember these categories. Financial goals and objectives, what are they saving for? Growth, income, safety. Financial circumstances, income, expenses, assets, liabilities, personal circumstances, age, family, job stability, dependence, investment knowledge, beginner, intermediate, expert. Risk tolerance, how much volatility can they stomach, and time horizon, short, medium, or long-term for their goals.
Right, those specific buckets of information.
Yeah, expect questions testing if you know what fits where, and accuracy is key. Incomplete KYC is a huge risk.
And it's not static, right? You mentioned updating it.
Absolutely. It's not a one-and-done thing. Lives change, marriage, kids, new job, inheritance, retirement looms closer.
All sorts of things.
Exactly. So reps need to make reasonable efforts to keep that KYC info current through periodic reviews.
Okay, makes sense. Now, knowing your products, beyond the name, what key things about a mutual fund must we know for the exam?
Focus on its features. What type of fund is it? Equity, bond, balanced? What's its objective and strategy? How does it try to make money? Management style, active or passive?
Okay, the basics of what it is.
Then the risks. Understand the main types. Market risk, interest rate risk, credit risk, currency risk. You don't need to be an expert, but know what they generally mean.
Got it. And fees are always big.
Always. Know the different sales charge options, front end, DSC, or back end, no load. Understand the MER, the management expense ratio, and what it covers. Trailing commissions, too.
And where do we find all this?
Primarily the Fund Facts document. Know that document inside and out. It summarizes all this key info.
Fund facts. Okay, so understand the fund's purpose, risks, and costs. Now, how does this all play out when a client actually wants to buy something? Solicited versus unsolicited orders.
Right. Big difference. A solicited order is one the rep recommends.
Okay.
For those, a full suitability assessment must be done before the trade is placed. That's mandatory.
Before. Got it.
An unsolicited order is when the client comes to you and says, I want to buy Fund X without your recommendation.
Okay, they initiate it.
Yeah. Now, even though the client is driving, the rep still needs to use the KYC info they have to assess if that purchase seems, wildly unsuitable.
So you still have a responsibility even if it's their idea.
Yes. If it looks like a really bad fit based on their profile, you should discuss the concerns with the client, document it, and maybe even involve your branch compliance officer before proceeding. You can't just ignore a clear mismatch.
Interesting. So even unsolicited orders aren't a complete free pass on suitability checks. Okay, let's summarize the rep's core functions from Chapter 1, thinking about exam takeaways.
Okay, key functions to remember. 1, obtain and update KYC info. 2, assess suitability matching products to that KYC. 3, explain misfits, tell a client if their request seems unsuitable, maybe suggest alternatives.
Right.
4, understand their sales scope is generally mutual funds know when complex stuff needs a referral to, say, a financial planner. And 5, crucially, the obligation to refuse an order if the KYC is insufficient to even make a suitability judgment.
Okay, refuse if you don't have enough info. That really paints the picture. It sounds like so much boils down to diligence, integrity, acting responsibly.
That's the core message of Chapter 1. It really lays the groundwork. This role is built on trust, adhering to those legal, ethical, and professional standards, especially KYC, and suitability protects everyone involved.
So for anyone hitting the books for the IFC exam, Chapter 1 essentials are: nail down suitability and its components, understand the 3 responsibilities, know the KYC elements inside out, grasp key product features, risks, fees, understand solicited versus unsolicited orders regarding suitability, and the importance of compliance.
That's a fantastic summary. Master those foundational points from Chapter 1. And you're not just prepping for the exam, you're setting yourself up for a solid ethical career in this field.
Absolutely. Maybe a final thought for you as you study. Try to imagine applying these principles. Think about different client scenarios. Young couple, retiree, cautious investor, someone wanting high growth. How would KYC, suitability, and ethical considerations play out? Thinking through those practical examples can really make these concepts stick. Thanks for joining us for this deep dive into Chapter 1.